Ever wonder how a simple stock split could radically impact your portfolio? SCHD's 3-for-1 split is an investor's dream come true. SCHD, one of the most popular dividend ETFs out there, has announced a major stock split. If you want to know more about the basics of this split, make sure to watch our previous video. But this isn't just another routine move. It's something that could change the game for investors like you and me. In this video, we're going to break down exactly what this stock split means, why it's happening now, and how it could boost your long-term portfolio growth. Whether you're already an investor or just considering adding SCHD to your portfolio, you won't want to miss the details we're about to cover. Chapter 1. What is a stock split? Alright, let's start with the basics. But if you watch my previous video, feel free to skip this section. A stock split happens when a company divides its existing shares into multiple new ones. Think of it like slicing a pizza. If you had one large pizza, cutting it into more slices doesn't change the size of the pizza. It just means you have more pieces to share. The same goes for a stock split. You get more shares, but the total value of your investment stays the same. In SCHD's case, they're doing a 3-for-1 stock split. This means for every 1 share of SCHD you currently own, you'll soon own 3 shares. But here's the catch. The price of each share will drop. For example, if a single share of SCHD is worth $84 now, after the split, it will be about $28 per share. But don't worry, the total value of your holdings won't change. It's just distributed across more shares. So why do companies like SCHD do this? Well, a lower price per share makes it more affordable for new investors to buy in. It also improves liquidity, meaning it's easier for people to buy and sell the stock. In simpler terms, a stock split doesn't change the fundamentals of the company. It just makes it more accessible and potentially attracts more investors. And more investors usually means more long-term growth. Chapter 2. Why is SCHD doing a stock split? Now that we understand what a stock split is, let's talk about why SCHD is doing it right now. Timing is everything when it comes to stock splits, and SCHD's management picked the perfect moment. Over the past year, SCHD has seen some impressive growth, around 18%. On top of that, they've just announced a major 15% increase in their quarterly dividend. This means the company is not just surviving, it's thriving. And what better way to capitalize on that momentum than by making the stock more accessible? A lower share price attracts more retail investors, people like you and me, who might not have had the cash to buy into SCHD at $84 per share. After the split, at around $28 per share, it's suddenly more affordable. More buyers means more liquidity, which makes the stock easier to trade and less volatile. But there's more to it. Stock splits can also create positive market psychology. When people see a lower price, they think they're getting a bargain, even though the value of the investment hasn't changed. This increased demand often pushes the stock price back up over time. So, to sum it up, SCHD is doing the stock split to attract more investors, boost liquidity, and set the stage for future growth. They've built strong momentum, and this split will help carry that into 2024 and beyond. And for investors, that could mean serious gains down the line. Chapter 3. Impact of the stock split on investors. Now, let's get into what you really want to know. How does this stock split impact you as an investor? First, it's important to understand that the value of your overall investment doesn't change. If you own 10 shares of SCHD today, after the split, you'll own 30 shares. The only difference is that the price per share will drop by about 2/3. So if SCHD is trading at $84 now, each share will be worth around $28 after the split. But here's the interesting part. While the number of shares increases, your dividend payments will stay the same overall. For example, if you were getting $3.58 per share in dividends before the split, that amount will adjust to match the new share count. So while the dividend per share will be lower, you'll own more shares, meaning your total dividend payout remains the same. What's really exciting for long-term investors is the potential for reinvestment. With more shares, you're reinvesting dividends faster. More shares means more dividend payments, and the more you reinvest, the faster your portfolio can grow. This compounding effect can lead to significantly higher returns over time. The psychological impact is also worth noting. A lower price per share makes SCHD seem more affordable to potential investors, which can drive more buying activity. More demand could push the share price back up over time, creating additional growth for current investors. So, in short, the stock split makes SCHD more accessible to new investors, while current investors can benefit from easier reinvestment and potential long-term growth. It's a win-win for both sides. Chapter 4: Dividend Growth and Reinvestment. One of the best parts about SCHD's stock split is how it ties into dividend growth and reinvestment. As a dividend investor, you know that reinvesting dividends is key to building wealth over the long term. After the stock split, the opportunity to reinvest dividends gets even better. Why? Because you'll own more shares, which means you'll be reinvesting more frequently. Here's how it works. Let's say SCHD is currently paying $3.58 per share annually in dividends. After the split, the dividend per share will be adjusted to match the new number of shares, but your total payout remains the same. So while each share pays a lower dividend, you'll have more shares paying that dividend, making it easier to reinvest and grow your portfolio faster. This is where the power of compounding really kicks in. Every time you reinvest your dividends, you're buying more shares. More shares mean more dividend payments, which then get reinvested again. Over time, this snowball effect can lead to substantial growth in your portfolio. The earlier and more consistently you reinvest, the larger the snowball becomes. On top of that, SCHD has a strong history of dividend growth. In the last year alone, their dividend increased by over 15%. This means not only are you reinvesting dividends, but those dividends are also growing over time. With more shares and a rising dividend, your returns compound even faster, helping you build long-term wealth. Chapter 5: Is it a good time to buy SCHD? So, the big question: should you buy SCHD before or after the stock split? The short answer is, it really doesn't matter. Here's why. Whether you buy shares now or after the split, the value of the ETF remains the same. The only thing that changes is the price per share and the number of shares you own. If you buy now, you'll get fewer shares at a higher price. If you wait until after the split, you'll get more shares at a lower price. But either way, the total value of your investment will stay the same. So trying to time your purchase isn't necessary. What really matters is the long-term potential of SCHD. With strong fundamentals, solid dividend growth, and the stock split attracting new investors, SCHD looks like a good bet for those looking to build long-term wealth. If you believe in SCHD's potential, the smart move is to buy whenever you feel comfortable and start letting those dividends and reinvestments work for you. Timing the market rarely works, but time in the market does. So whether you buy now or later, the key is to stay invested for the long haul. Chapter 6: SCHD's recent performance and future prospects. Now let's talk about SCHD's recent performance and what the future could hold. Over the past year, SCHD has delivered an impressive 18% return. That's solid growth, especially for a dividend-focused ETF. On top of that, SCHD's dividend has been growing steadily, with a recent 15% hike in the Q3 payout. This combination of capital appreciation and dividend growth makes SCHD a powerhouse for long-term investors. Looking forward, the stock split could fuel even more growth. By lowering the share price, SCHD becomes more accessible to new investors, which can increase demand. More buyers could push the price back up, creating a cycle of growth. Plus, with the Federal Reserve lowering interest rates, there's potential for more capital to flow into the stock market, benefiting ETFs like SCHD. SCHD's strategy focuses on steady, long-term returns, and it's designed to provide income through dividends while also offering growth potential. It's not a high-risk, high-reward play. It's more about consistency and stability. Alright, let's wrap things up. SCHD's upcoming stock split is more than just a routine adjustment. It's a smart move that could open the door to even more growth and higher dividends for investors. By making SCHD shares more affordable, the split is likely to attract new buyers, boosting demand and potentially driving the price up over time. For current investors, the stock split doesn't change the value of your holdings, but it does make it easier to reinvest dividends and take advantage of compounding growth. If you're serious about building long-term wealth through steady dividend payments and solid growth, SCHD is definitely worth your attention. So, what are you waiting for? If SCHD isn't already part of your portfolio, now might be the time to consider it. Don't forget to like this video, subscribe for more investing tips, and hit that notification bell so you don't miss the next one. See you next time.